Over the Road magazine article, October 2009. Factor financing equals hyper retail. Financing a highway tractor when there are thousands of pieces of idle equipment should provide some pretty sweet deals. But sometimes, if an operator isn't looking, they can get shafted. Here's an example. An operator agreed to purchase a 2005 truck for $49,000. He traded in his 2001 for $11,000 and submitted an additional $5,000 in cash. The dealership arranged a financing company to purchase and lease out the truck. The terms, however, were $1,519.79 for 36 months with a $100 buyout. That's a total payments of $54,712.44 on a truck that the financing company shelled out only $33,000 for. Because the residual value buyout was only $100, Canada Revenue Agency demands that the lease be capitalized or depreciated. Unfortunately, this requirement differs from what leasing companies imply at the time of signing. Too many still say every payment can be written off. The arguments rage on between CRA and leasing companies, but operators still end up reporting their taxes the way they have to. There may be hidden reasons why leasing companies argue so strongly. Operators must calculate deemed interest on their deemed purchase. In this example, the transaction triggered a 36.4% interest rate. The combined rate with the fact that if the truck was written off in the first few months, the entire $54,000 would be due immediately. Since insurance wouldn't pay out more than $49,000, the operator would lose yet another $6,000 in cash. How does the leasing company justify this rate of interest? Simple. They don't call it interest. It's called factoring. They purchase a truck for a guaranteed buyer, arranged by the dealer, and they resell it for a higher amount. This type of financing is not typical financing, it's factor financing. Someone other than the dealership has agreed to resell the truck at a much higher price. It's retail on retail or hyper retail. If you're an operator who is presented with factor financing, I suggest you reevaluate your business model. It is oftentimes much better to invest $16,000 rebuilding an engine than to throw it away to a factor financing scheme. If you are in doubt about your deal, refuse leasing. As I demonstrated in my book, the advantage almost always lean towards owning anyway. Any benefits of leasing would only be temporary at best, but may hide disadvantages that can down on any operator, no matter how careful. If you are considering upgrading your equipment, remember to ask your mechanic, not your accountant. Very few accountants will ever know the mechanical strength of your truck, which is the primary reason for upgrading equipment. With all the trucks and deals available on the market today, most operators should be able to build value. However, a hasty decision in a downtrodden market may drive some operators to the poorhouse. Have a good trip.